Samir Arora of Helios Capital joins us from Singapore. Thank you so much, Mr. Arora, for joining us. The last time I spoke to you, we ended on a bit of a negative note, I would say, because you said that you're telling any young person who comes to you for advice, you're telling them, don't join finance. That world is over. The world of
the arbitrage is over.
Arbitrage.
You still join finance, but it won't be materially different from other jobs that you may have.
Okay. All right. So, if a young person came to you now, what would you advise them? They're starting on their career. Given the way in which global economy is working, you're sitting in Singapore, which is kind of a place from where you can see what is happening across the world. What would you tell them? What should they do?
So I read somewhere that in a few years, either the computer will tell you what to do or you will tell the computer what to do. There will be only these two kinds of jobs. So in general, you have to either be an innovator, be part of that, or if you do a normal job where there's no client relationship, no client-facing activity, then A, those jobs will be less, and B, there is a high probability that they will be automated in your life. In the case of finance, my story used to be that if you are, 90% of the people don't really have inbuilt passion when they start looking for a job. They will do whatever is available and if it makes sense. And there was a clear arbitrage in the sense that if you chose a finance job, financial services job, banking job related to a manufacturing job or any other thing, you would materially do better and you will be in a environment where you will interact with higher quality people, better educated people and generally globally oriented people. Now the issue with finance jobs is that if you get fired, most probably you'll not get back, so risk adjusted returns are not very high is what I feel. But today if you want to do something tech oriented, starting businesses, starting a tea shop, all those are quite interesting.
Starting a tea shop, you said, or a PE?
As a joke, it is that anything which you can do on your own doesn't even have to be tech oriented. But now you see all the companies that are going public. Yeah. People have thought of these jobs, these businesses many years ago, which we didn't even know that there are such businesses that would come about, whether it is testing laboratories or it is people making perfume and things like that, which normally doesn't come to your mind. And now because private equity is available, that allows some of these businesses to get some initial funding, etc. And therefore, as a business or as a young guy, if you have some passion, you can mix it with this. Finance is good if you don't have any other thing other than money as your interest.
Okay, that seems to be most of the people watching us right now. But okay, Samir, using that as an entry point, I want to pick your brains on what do you think of this entire e-commerce space? And I specifically want to know about how long can you continue to sell the idea that you're only in the area of customer acquisition and cash flows don't matter?
So, e-commerce is a good idea, but e-commerce valuations are absolutely stupid. And the second thing is for people to believe that we have 1.2 billion people who will come online one day and will shop. That is why I am against e-commerce. As a concept, it's okay because Amazon has demonstrated the scale of how things can happen and how big and far they can go. But in India, the issue is that we have genuinely started believing that we have 1.2 billion economically equivalent people and we don't have. We have maybe 100, 200 million people. My best example which I use is if you look at the IPOs of some of these consumer companies that have been around, consumer facing and consumer companies that have been around 10, 20, 30 years, and you look at their branded sales. If they have sales of 100 crores, they start calling them power brands. If they have 500 crores, they feel that God knows what they have done. But all you have to do is convert it into dollars, and it is like $15 million or $75 million, at which point it is considered as the biggest success in a brand that India has ever seen. Where in US, an immigrant started a yogurt company, and that yogurt company called Chobani has sales of I think $2 billion, and he started it about I think in 2007 or 8. So for us, we compare our market caps by saying, oh, this is 10 million and 100 million, whereas the sales that we have are 10 and 15 million relative to billions there. That's why I think e-commerce as an idea is good, e-commerce as a business is good, its valuations and dreams are totally unrealistic.
So obviously, you meet people who invest in them. I mean, I'm not naming the companies, some of them would probably be your friends who handle these funds. They invest in Indian e-commerce companies. What is the game plan? How do they intend to make money?
The logic is that it is a big picture. Fraud is a wrong word, but it's actually a fraud. The fraud is that the guys who come in at $15 billion are protected. They are protected, and this is in every company. In every of these where they say $1 billion and $2 billion valuation are not actually $1 billion because the last guy who comes in, and if he's coming in say 50 and 100% higher than what was the valuation 9-12 months ago, that is in a short period of time, normally is protected to the extent that if the IPO of that company happens at say 700 million, he will be given more stock so that he breaks even at 700. If the valuation, if the next money raising or the IPO is at 1.1 billion, let's say, then he would have bought it at $1 billion. So in some sense, he's protected from the downside. It is just a story that is told to keep the game moving bigger, to have the game become bigger and bigger. Why I am totally against this is because when these companies are owned by publicly listed companies, according to me, SEBI should come in and intervene because they signal a different thing and impacts the listed company. Otherwise, if the company is completely unlisted, they can fraud as much as they care. Nobody cares other than those private equity investors who want to keep the ball in the air. But otherwise, according to me, it is cheating, yes.
Yeah. So in a sense, it's based on the greater fool theory, right? That you have to pass it on to the greater fool at some point.
No, actually it's not. Because the last guy does not care. He's protected even if he's bought it at $1 billion and it actually in the end gets sold or IPO'd at 500 million, he would not lose.
Yeah.
He will be given extra stock. Other people, in theory, will lose. The other investors of that, because they currently think they own 80% of the company, let's say, and when this new guy comes in at $1 billion, and in the end, the valuation becomes 500 million. The original investors will lose, or the not original, but the this round investors will lose. A, because the valuation is low, and B, they will have less shares. So the last guy, in that sense, is indifferent. As long as he broadly thinks it's okay because he's not actually investing at $1 billion. That is why I think it's a fraud. Because if this company is owned by a publicly listed company, then the publicly listed company share goes up on sum of part basis because they think that this part is worth $1 billion, whereas nobody has really put money at $1 billion. He's just put it at $1 billion if it goes up. Otherwise, he's put it at whatever is the price of the next round.
So, I have two related questions here. One is domestic and the other is global in a sense. But let me start off with the domestic question. In the last 1 year, I mean, in the calendar year of 2015, I think we saw about $21 billion being pumped into e-commerce companies in India in terms of investments. They made a collective loss of, it's difficult to get those numbers, but what the media reports is about 12 to 15,000 crores. A lot of it is, of course, subsidies to consumers like me who go to these places, buy stuff, and that has kind of allowed that consumption to continue, that consumption story. Some of it is, of course, Chinese goods. I mean, often one buys something on Amazon or Flipkart and then finds it's made in China. But it has pushed a consumption boom in the last 1 year where offline retailers have also had to push down prices, right? There's a subsidy coming through e-commerce which is depressing prices and allowing the effective demand to come up because of that reason.
So what is wrong with that?
No, my question is that what happens, does that compress retail margins? Does that compress margins for product producers? What does that do?
Of course, for retail, in a big picture sense, is very negative. Actually, all innovation is negative for the current guys, and that is why stock market returns are going down for two reasons. First reason is that private equity funding allows businesses to go public much later than they would have had otherwise. So, for example, in 1990s, we made some 100 times on Z. Now, in today's environment, Z would not have gone public at a 50 million market cap. Therefore, the public market guys could not have made that much money. Second is all innovation, not e-commerce only, but any. You look at even this taxi thing. If there was a listed publicly available taxi transport company, it would have been hit. Basically, anything new that is happening is, in one sense, you can say creating a new demand, but generally is a more efficient or some other form of competition with the current crop. In fact, look at it even bigger picture. Our government wants ease of doing business and wants a very high rank of India in ease of doing business. High rank in ease of doing business is bad for my stock market because we don't like ease of doing business for new people. We are already investing in companies that are already in India. So if you suddenly allow licenses opening up, hundreds of new people come in and the same market gets shared. So everything that happens new is negative for the stock market.
The reason I was asking is that, there was one day when one e-commerce company last year announced that they've sold 1 lakh bikes. Now, 100,000 bikes within a period of 1 day or 2 days or something like that. Of course, questions were raised about that later on, but that is in a sense an artificial demand created because the subsidy was borne by that e-commerce company. But when the numbers come out, it looks like that consumption has revived, companies are managing to push out a lot of sales. That's what I'm trying to ask you. That is there an optical illusion being created there?
So you are of the kind, because you seem to be a bearish guy and I'm a bullish guy. So if suddenly NDTV gave you a massive bonus this year, you will feel depressed because you will say, but next year they may not give me. Right now, celebrate what
absolutely right.
Right now, celebrate what is happening and what is being given to you, and hope that over time, something else will happen. There will be a natural growth. But of course, in a very short period of time, if there's a sale, you are effectively borrowing from the future that same sale which would have taken otherwise 6 months. Right. Now, you can choose to be depressed that the 6-month sale happened in 1 month, and we'll say, wow, 6-month sale has happened in 1 month, and in the other 5 months, something may still happen.
No, when I enlarge it to an economy, of course, you're absolutely right. I'll probably feel depressed that next year I'm not going to be that rich. But when I enlarge it for an economy, right, what signal does it send? Let's say I am a motorbike manufacturer. And what one could call effective demand is actually coming in. It appears to me there's demand because there is a subsidy being borne by a fund, maybe Tiger Capital or SoftBank, I don't know, whoever, right? And now I feel that demand has revived and therefore I should increase my capacities. I should invest a little bit in capex because the demand signal that is coming to me is artificial.
Well, the guy who's selling the mobile will know how much of his sales got really done at those prices because he'll track them a little bit more. So maybe he will not read that signal as literally as you are doing. But if you look at, let's say, oil price fall which has helped India to the extent of $40-50 billion a year. Now, many people come and tell me, not now, but they were saying it initially when the prices fell so much, that this is unsustainable. And what if it goes back? I said in 2000, it was $100 and we were still giving a bullish spin in life. In between, now we've saved as a country, let's say, $100 billion in foreign exchange. And so what's wrong even if it goes back to 2013? So I'm saying, let's say this motorbike guy goes back to what was happening 1 year ago. What was so wrong with what was happening then? Nothing. In between, some guys got a subsidy and the guy was able to sell his mobile. So maybe he has borrowed from the next 5-6 months of sales which would have otherwise happened. It doesn't matter. You're not buying a stock for 5 months. These things don't matter so much, except maybe to a company or two. What matters is in general if the job opportunities in new areas are less, which I think it is. And in fact, e-commerce's biggest contribution may not just be in subsidizing the consumer, but in creating employment along the curve from delivery guys to logistics guys to all these executives who are working, because we don't have a big job creation engine, which previously was the tech guys in the 90s. And we need either tourism or manufacturing or something which has large amounts of people getting reasonably good employment and consistent with their own level. That e-commerce may have helped a little bit in because if you get one guy a good job, it actually looks after 3, 4 people, the family, maybe a helper, some driver, it creates lots of ancillary jobs.